Good morning, everybody. This is Dan with Cochise County in the budget office, and this is our fifth webinar we've been doing about budgets, and today's the big one. We'll be talking about property taxes, but first, we've got our very special guests from the Public Safety Personnel Retirement System. We've got Mike Townsend, the administrator, and also Christian Palmer, their communications director. So we've got his slideshow up there now you should be seeing, and I want to welcome Mike and Christian. So Mike and Christian, if you want to take it ahead and introduce yourselves and get started, we're excited.
Thank you, Dan. This is Mike Townsend. I'll kick this off before I turn it over to Christian. I'd like to thank Cochise County and also thank your Board of Supervisors for the opportunity. I'm the new administrator. I've been here a little over 6 months. I started last December. And prior to that, I spent the previous 20 years with Coconino County in Flagstaff. So I have a pretty good understanding of where you're coming from and what the challenges are. And really, that's one of the reasons that I wanted to take on this role, was understanding the challenges of the employers, the stakeholders, and how important this issue is. And over the past several months, we've made a lot of changes. Completely new management team, new accounting staff, and then also have some other long-term employees very committed to the system, including Christian, has been with the agency for several years through a lot of the pension reforms and has a pretty good historical perspective on all of that. So again, thank you, Budget Manager Dan Deshawn, for your help in getting this organized. I appreciate all of that. And I'll turn this over to Christian to get started with the presentation.
Good morning, Dan. Like Mike says, thank you for hosting PSPRS. Thank you for having us on. Your interest in our pension system and our shared commitment to public safety. We're going to get going here on this on our presentation. And the first things what I'm going to cover before turning back over to Mike is a little bit about the basic functions of PSPRS, how PSPRS is managed, and finally, the meat of it, our investments. So let's go ahead and just ask yourself, what does PSPRS do? We manage 3 public pension plans. We manage, of course, the public safety pension plan, the elected officials, which includes judges, which is the plan called EORP, and we also run CORP, which is the pension plan for corrections officers in the state of Arizona. We also run several defined contribution plans for PSPRS, CORP, and EORP members, and soon we'll be bringing a 457 plan online as well. We have about 60,000 active members and retirees across the state. We serve more than 250 employers of public safety officers. Currently, we're running about $10.5 billion of assets under management. And these are the assets that are invested, that of course produce one of the streams of money for pensions for our retirees. Last year and about every year, we distribute $1 billion in benefits, and most of our retirees continue to live in Arizona. So that's a pretty big economic generator. If we look at who manages PSPRS, we have a 9-member board of trustees. We have 4 of the 9 are currently serving members of the public safety community. We have 2 members who are law enforcement. We have 2 members who are firefighters. They have experience working similar, boards and functions for their local governments, as well as their regular duties serving the public. We have 5 civilians who are nominated by representatives employers. It includes your County Supervisors Association, your League of Arizona Cities and Towns. And these civilian members have very stringent requirements for level of expertise for serving on our boards. They have the most stringent requirements in the state of Arizona, as a matter of fact. They need 10 years, at least 10 years of high-level financial experience. Most of our guys are running between 30 and 40 years of very, very high-level financial experience. That includes investing assets. That includes running big corporations. We are pretty fortunate in the fact that we have an extremely high level of financial expertise on our board. A lot of people kind of have questions sometimes. We are subject to all Arizona statutes. We are a state agency. We have open meeting laws to adhere to, public records laws to adhere to, and our board and staff have what are called fiduciary responsibilities to the plan and to our membership. Now, getting into investments, of course, this is always a very big topic of interest, especially nowadays with what we're seeing in the markets. So we're going to go through a little bit of the basic concepts for to make sure that everyone somewhat knows what we're talking about here. Now, you'll hear terms like portfolio. A portfolio is a collection of assets, collection of investments that we hold. Typically, we hold about 30 to 40% of our investments in publicly traded stocks. That'll be stocks that you see on the stock market. Those will be in the form of index funds, because when you have $10.5 billion, you can't sit around and just do individual stock picking. You'd be there for years. We have a small degree of bonds, which people should be familiar with, and then we have a great assortment of private investments, which we'll get into in a little bit. Private investments talk about private equity, which is the buying and selling of companies. We have real assets in the plan, which is things like timber, mining interests, agricultural, all kinds of things. We have venture capital, which of course these are companies that go out and lend money to your Apples of the world, and they help startups like your Airbnbs or your Ubers and things like that. So we have a degree of exposure in venture capital, which is pretty exciting. Last but not least, we have quite a bit of real estate in our fund. Risk tolerance. Now, risk tolerance is a very important concept to understand for everybody when it comes to investing. Risk tolerance is basically how much money you can afford to lose in any given scenario here. PSPRS, as we mentioned, has more than 250 employers in our system. Some of our employers are faring better financially than others. Some are already struggling with very high contribution rates. So PSPRS's primary goal is to play somewhat of a defense-first strategy and not lose money, because if we lose money in any given year, of course, the impact is going to be increased employer contribution rates, which we are trying to avoid at all costs. So we run a very low-risk investment strategy. A high-risk investment strategy would be something like if you were, heavily exposed to the stock market, like a traditional, 401k balance that most people have is going to be around 70% stocks to 30% bonds. Now, that's actually a pretty risky scenario, given the fact that stocks can move up greatly in a given year, and they can also move down substantially, like we saw in March, when the stock market dropped about 30%, which was a very scary reminder of just how volatile stocks can be. Now, given that, with the main thing to understand about risk tolerance in investing is that investing requires risk in order to make money, because no one is going to reward a safe bet. Safe bets like bonds produce very low investment returns. So if you want to get up into actually producing returns over long periods of time, you need to take some degree of risk. The greater the risk you take, the greater potential for high returns is. And of course, like we saw in March, the greater the potential for big time losses. Now, investment strategy is very important to understand. We've been talking about this a little bit here just through my other comments. What we're talking about is how you design a portfolio in order to reach the goals and the liabilities that you have in the plan. PSPRS is not a 401k plan. It is a living, breathing trust that must be used every single month to distribute pensions. Typically, in a given month, we distribute about $80 to $90 million worth of pensions. And like I said, about $1 billion over the course of a year. Now, we need to be able to count on distributing pensions not just this month or next month, but 10 years from now, 15 years from now, 20 and 30 years from now. So an investment strategy for PSPRS has to take our risk level into account. It has to take the amount of liabilities we have. That's the pensions that we're distributing. We have to look at our time horizons and other factors. Different plans, this is very important to understand, different investment plans have different strategies. because they can have entirely different set of circumstances, like that risk level, the liabilities, and timeframes. Now, return. It sounds easy enough, and it is. The return is the level of growth that you will have investments generate. It'll reflect a increase or a decrease in the value of investments. We measure these over 1, 3, 5, 7, and 10-year time increments. Also, occasionally we measure them in longer time frames. We measure our returns against what are referred to as benchmarks. Benchmarks are basically a set of numbers that's determined to estimate what a future return will be in a given year, or 3-year, or 5, or 7, or 10-year periods. We do have an assumed earnings rate of 7.3%, which means that we expect over time our plan to produce a 7.3% investment return. In any given year, of course, you can come in above 7.3%, and you can come in below 7.3%. Your benchmark is what's going to give you an accurate idea of where you should be in given any current state of markets or any sort of economic weather that would be unexpected or the like. Risk-adjusted return. This is also a fairly important concept to get into. Risk-adjusted return is a measurement of strategy. I guess it's measurement of what we're talking about, because PSPRS, as we mentioned, we run a very low risk investment plan. So we need to know exactly how much money we can afford to lose, and we need to know how much money that we are capable of generating and how much money we are generating when we're operating within that identified risk profile. This is the bang for the buck measurement, as I like to say. And what it does is it separates skill from luck. Our investment team needs to know how much reward they're getting for the amount of risk they're taking. It's not a plan where you're simply speculating and buying assets and hoping for the best. They need to know exactly how much return they're going to get for the amount of risk. Volatility. We talked about this a little bit. Volatility is the measurement that your investments can produce. It's the distance between the probability of a very high return and the probability of a very low return. That distance between those 2 points is referred to as volatility. Stocks, as we talked about, have gone up as much as 20% in a year, and they've also gone down 30% in a month. So that distance between a positive 20% and a negative 30% is your amount of volatility that you have. Now, if we get into our investment strategy, again, we've covered this a little bit. We're here to maximize our returns without taking risk that puts our employers in jeopardy. For executing this strategy, we run a pretty small degree, we hold a few stocks, as a matter of fact, considering the size of our portfolio. We have less than 40% of our portfolio assets in the stock market. This is about half of the standard allocation that you see in many public pension plans or trusts. We diversify our investments heavily across 11 asset classes. And the whole point of this is to avoid somewhat of a domino scenario where one asset class, like the stock market, takes a hit. Then we see that effect ripple throughout the portfolio and have the portfolio lose value. The whole point of diversifying is to avoid that effect. And when we get into the numbers of how PSPRS portfolio is dealing right now with the coronavirus pandemic and the resulting economic damage, we'll see that. What we're running here, the objective and the skill, again, is to maximize our returns while operating with an acceptable risk level. This protects our employers. And on the other hand, we know when we're running this very safe investment strategy of high returns in years when the stock market is red hot. If we take a look at our PSPRS portfolio, you'll notice the degree of giant slices out of that pie. That is a very diversified portfolio. It's one of the most diversified public pension portfolios in the nation. You'll notice that we have all sorts of asset classes throughout there. We've described a few of them earlier. And now if we look at a traditional trust, public trust, we'll see how standard that investment is in comparison. Here I pulled the general portfolio allocation of the state treasurer's office, which has an entirely different investment strategy. They have entirely different liabilities, and that's why their plan looks very simple. And PSPRS in turn looks a little bit more complicated, and that's for the reasons that we described. Now, PSPRS operates on an assumed earnings rate of 7.3%. Again, this is how much we expect our plan to generate over long periods of time. In any given year, this year we will come in, it's almost certain we'll come in below that 7.3%, and that is not a cause for alarm, because what we're looking at is very long time frames for our investments to generate that return. Our return, net of fees, that means after all of our investment expenses have been taken out, as of the last fiscal year, ending in the summer of 2019, we generated 5.5% return last year, which was $580 million in cash. Over a 3-year time period, we had 8% return. And over the 7-year period, we had 7.5. 10-year, we had 8. You'll notice our most important numbers here are going to be our 7 and 10-year returns. And thankfully, those returns exceeded our assumed earnings rate. So that reflected our investments producing a net gain for our plan and for Arizona employers. Now, of course, a lot can happen in a year. In this case, it's just about almost a year. We're almost at the end of the fiscal year right now. So given what we've seen with the coronavirus, let's take a look at how the PSPRS plan is faring. We'll notice that since July 1 of 2019, the S&P 500, the general index fund, which is a great measurement of the overall economy, was red hot. It was gaining about 14% for the since July, all the way up till mid-February. Mid-February, it stumbled, and by March, the market had lost more than 30% of its value compared to the high that it enjoyed in mid-February. That is a crushing blow for the stock market. And again, that's the exact reason why we're diversified, so we can thankfully avoid the brunt of that impact. Because if we had to turn in a negative 30% loss in any given years, the corresponding increase for employer contributions could be very damaging to local governments. So that's something that we absolutely try to avoid. Now, if we look at how we've performed, our most recent numbers would be for the period ending in April 30th. So we still have a couple months to come in to get our measurements, but as of April 30th, the PSPRS portfolio for the fiscal year had only lost 1% of value. Now, while you're never really pleased with losing any money, the fact is that we lost 1% while the standard pension was down anywhere from 10 to 13% in value for their fiscal years. Comparatively speaking, that's pretty excellent, and that's an absolute reflection of the degree of care that our investment team has put together in building the PSPRS portfolio. Despite losing 1%, PSPRS performed better than 75% of its universe of peer pension plans. So that's something, again, we're not thrilled about having a loss as of April 30th. It is a slight loss, and it is certainly within acceptable range, and it's certainly acceptable considering how bad some of the alternatives could have been. Now, with that, of course, we'll be opening this up for questions later on, but for the time being, I'm going to turn this over to Mike Townsend, who's going to talk about unfunded liabilities and Cochise County's standings.
Thank you, Christian. So in this part, I really try to go through and explain this so that people can understand the math of pensions. From a high level, they're pretty easy, but it gets complicated as you dig down in the detail. So I really like to start at the beginning to make sure that everybody understands and we're all on the same page. And as I go through this, there's going to be a few key points that are often missed or even misunderstood that can really cause confusion. So we want to start at the beginning, but first have some initial thoughts on slide 12. Across the state, the unfunded liabilities of the pension are a huge problem. In aggregate, it's looking at over $9 billion of unfunded liability. That's a 46% funded status for the public safety system. And that's an issue because it really is a debt. It's not if that unfunded liability will be paid off, it's when and by whom. And when I say by whom, I mean which generation is going to be left with this bill. And another thing that's really important to understand is depending on other factors, just making the minimum annually required contributions may not be enough to reduce that unfunded liability going into the future. It really takes a thorough understanding of the math and how it works. So going to slide 13, it's really important to understand that the pension reform does not reduce the unfunded liabilities for tiers 1 and 2. That's a legacy cost. That's a debt that is going to have to be paid. Pension reform created the new tier 3, and that is a benefit. That does have a lower cost for employers. But that's for new hires going forward. It cannot go back in time and change what was in place for tiers 1 and 2. Now, Prop 124 that was passed by the voters across Arizona, that helped. That replaced the investment return-based permanent benefit increase, which is referred to as the PBI, with an annual cost of living increase that's capped at 2%. So it's a smaller percentage than what was usually in place with the PBI, and it's something that's more certain so we know what we have going forward. But we need to remember that savings created by Prop 124 is already in the actuarial assumptions. That's in the valuations. So it created almost $500 million in savings system-wide, but it is reflected in the current unfunded liabilities that are being valued. So if we go to slide 14, we refer to the public safety pension as a defined benefit. And that's important to understand. It defines what the benefit is at the time of retirement, and it's a formula. So when we get there, in terms of a basic example, I just laid this out for a 25-year employee. You can see the numbers roll out depending on the years of service, what their pay was, and it comes up with an actual pension. So it is an actual liability that will be paid out. The complicating factor is estimating that liability for the future. I gave you an example there for a 25-year employee at the time of retirement. But if we have a 10-year officer who has earned a portion of their future benefit, we're trying to estimate how much longer that employee will work, what type of pay increases, how long will they be drawing that retirement, do they have a spouse that will continue to receive that benefit after they're gone? So there's a lot of things that go into the actuarial assumptions and estimating those future liabilities. So it gets very complicated. Slide 15. So this gets to our unfunded liability explanation of how we calculate this. So, and this is one of those key points that I have highlighted in red here. So as we start with the assets, as Christian was talking about, we do this every year. We close the end of the year, look at the returns. What are the assets as of today? So if we have June 30th, what's the value of the assets? In terms of the liabilities, we look at all those future benefits earned as of today. So that 25-year employee that's retiring, I gave you the example. We know what that annual pension amount is going to be. But we have to calculate and estimate what is that going to be throughout the entire lifetime. What are all those future streams of payments going to amount to? We also need to look at that 10-year employee and estimate how much of that career and those future benefits have been earned through these 10 years, and estimate what that earned amount is for those future string of payments. And then all of those future string of payments throughout their lifetimes are discounted back to a present value. And that's really key to how this math works as we go through the rest of this presentation. So we're looking at the assets as of today, present value of the liabilities, And then the difference between those two is the overfunded amount or the unfunded liability. We go to slide 16. When I started off, I stated, the aggregate system-wide for public safety is a funded percentage of 46%. And that's just using the same two numbers. So the plan assets as of today, present value of the liabilities stated as a percentage. So everything is in today's dollars. And obviously the goal we're trying to get to is 100%. So today's dollars, today's present value liabilities, we're trying to get to be the same number. On slide 17 is what's called the pension funding equation. So as we start thinking through pensions and how they work, it's always good to keep this formula in mind. It's a way to kind of simplify and get a high-level picture of how this works. So with this formula, I like to start on the right side of it. So the benefits and the expenses. The expenses are the cost of administering the system. So it's the cost of running the agency. And the expenses are actually the smallest number in this formula. It's actually a fraction of a percent. The benefits is actually the biggest number in this formula. So all of those future benefits to be paid out. So the right side, the benefits and the expenses are the uses of money. This is where the money goes. If we go now to the left side of this formula, the contributions and the investment income, this is where the money comes from. This is the sources. And as Christian talked, we have that balance of risk and return. We try to get as much return as we can, but we're really limited. We can't just keep taking on more and more risk and expect the investment income to go up. So we're limited on how much we can create in terms of investments based on the assets that we have and the risk tolerance that we need to balance. So contributions is really the one where there's the most variability in terms of decision making about how we make impacts to the system. And so I'll talk a little bit about how the contributions and future investment earnings play together a little bit later on. But with that, let's see, let's go on to slide 18. Okay, unfunded liability. So in terms of PSPRS, the liabilities are not pooled. In the Arizona State Retirement System, ASRS, for civilian employees, there is one liability statewide. All employers, it doesn't matter who you work for, you're part of one large liability pool and everybody pays the same contribution. For PSPRS, every individual employer, and as of the last valuation that was 264 different plans, we keep track of individual liability. And those, as we've mentioned before, those unfunded liabilities have been earned. That represents a future payment, and they cannot be diminished or impaired. And that diminished or impaired language comes from the pension clause in the state's constitution. And that pension clause has been upheld in the courts, setting legal precedent in court cases, the most recent being the Fields decision. So it is more appropriate. We call it an unfunded liability, but it is a debt. It is owed. And one of the things we're going to talk about here shortly is the amount and the timing of the contributions directly impact the funded status of your individual plan. Every additional dollar contributed today can enter investment returns going forward. Coming from local government, working for cities and counties, I understand a lot of the time we look at budgets in 1 year or a few years increments. In pensions, we think in terms of decades. And so when we start talking about additional contributions, it's looking at, well, what is that going to earn over the next several decades? And so every additional dollar really can be leveraged for investment returns, but the opposite is true. Having an unfunded liability and not having those contributions in place it's really a lost opportunity for those future investment returns. So go to slide 19. And we talked about contributions, but to understand this, we need to break this down to the two components of contribution. So there's what's normal cost, the annual cost of pension benefits earned in the current year. I had the example of a 10-year officer who has earned a portion of their future benefit payouts through their lifetime. So that 10-year officer works year 11. The additional future benefits earned in that present value calculation for that 11th year, that current year, that's what we refer to as normal cost. So what's added to normal cost to come up with the total contribution is the portion related to the unfunded liability. And so that unfunded liability is amortized similar to a mortgage. Cochise County has when it was at a 27-year amortization period, so what would the mortgage payment need to be to pay off that unfunded liability into the future? And so those two together are what make up the contribution rate. So if we look at slide 20, and we start to break down, when we look at what comes to cash coming in, increasing the assets available to be invested in the future and to pay the benefits. Where does that come from? Well, system-wide, you can see the employee and the employer contribution, a little over half. And so the investment income is about 45% of the total cash that came in. So what we were attempting to do is the more contributions we have, the closer we get to being 100% funded, that net investment income, the blue section of this pie, starts to grow. So we start getting more money from investments as opposed to contributions. So if we look at slide 21, we have some actual numbers for Cochise County from our actuarial valuations. And this is focusing just on the sheriff's plan. But any other plan is going to follow the same math. The numbers will change a little bit for each plan, but the math is the same. So slide 21, from a high level, looks at Cochise County funding and their contribution. So the first part of this graph, the funding level, in aggregate, the public safety system is 46% funded. That's a weighted average across the entire system. But if we look at what is just an average for all those different plans, the average is about 70%. And then you can see the orange is Cochise County Sheriff's Office funding level at 36%. So there's a pretty big difference there. In terms of contribution rates, so the gray bar is 41%, and that's the average across all employers of the contribution rates. And Cochise County, as you would imagine, having a lower funded percentage means a higher unfunded liability will have a higher contribution rate because of the amortization of that unfunded liability calculated for the contribution rates. So we go to slide 23. So this is looking at the total liabilities, unfunded liability assets, and I came up with a picture to try to depict this so you can understand how these work together. So the total of that bar, the blue and the orange together, represents the total present value liability for the sheriff's office pensions into the future. So those added together is $52 million, adding those two. So against that total liability, that present value liability, the assets that are being invested, you can see are $18 million, which leaves an unfunded portion of $33 million. So just to kind of give you a picture of where this was for the estimates evaluation for 2019. If we go to slide 24. So when you look at that chart, the investment returns are earned on the $18.4 million in assets. So if it was 100% funded, we'd have investment returns on $52 million. So it'd be a much larger return on investments that would change that pie chart about where the funding comes from. Now, this is another key point that is often missed, is because that total liability is a present value number. As we move into the next year, into 2020, that total $52 million is going to be discounted one less year, which means it's going to increase. And the discount rate that is used is the assumed rate of return on investments. And so the discount rate being 7.3%, the total, that $52 million of liabilities is going to grow by 7.3%, just by the fact it's discounted one less year. So if we go to slide 25, so the way this math works out is, so looking at FY19, and then through 19, look at the investment returns. If it hits the 7.3%, Christian talked about where we are with actual returns, but just from an actuarial assumption perspective, the investments and then the contributions together, a little over $4 million. So because the liabilities are present value, that was at 52 million. When we get to the next year, it's going to be discounted one less year. It's going to be 55 million, almost 56 million. So even though we have $4 million coming in assets, we're chasing that present value calculation as we go into the future for total liability. So if we go to slide 26, and so the 2019, these are the same numbers on 2019 from a few slides earlier with that unfunded liability. And then when you look at 2020, we start with that blue section being the same value of assets at that 18 million. And then the orange is going to be the investment returns, adding money into the plan. The gray represents the contributions. So you're increasing your assets. But in terms of that total bar chart, the top increased because the present value liabilities are discounted one less year. So you can see how it went from the 52 to the 55, almost 56 million. And so what happens is the change for unfunded liabilities went from 33,571,000 to 33,229. It went down, but it didn't go down anywhere near to the $4 million of assets added back into the plan. So we go to slide 27. Okay, and back to this pension formula. So again, how we think of things large picture is we need to realize that if we just, because of the way this formula works with the benefits and the expenses, and the only place that money comes from are contributions and investment, is just paying the basic contributions, just paying the ARC is not really going to keep up, because both sides of this formula are changing, the contributions, the investments, but also those benefits. What's the present value of the liabilities that we're going to need going forward? So go to slide 28. This is looking specifically at Cochise County using the information from 2 slides ago. And where do the assets come from in total for that fiscal year? So you break it down, the contributions, 9% comes from the employee contributions, 14% from the employer portion of the normal cost, which is what's earned for the current year. And then that unfunded portion of the contribution is about 44%. And then the investments provide 33% of the assets for that year. So you can see the breakdown of where this money comes from. It's pretty similar to the pie chart that we had for the system-wide public safety pension. So if you go to slide 29, a hypothetical, if Cochise County were 100% funded, you can see what would come from the employee, what would be part of the normal cost paid by the employer. But then 80% of the assets for that year would be provided by investment return. So having the money in here in terms of additional contributions you can really leverage those investment returns going forward into the future. So we go to slide 30. I talked about early on that just paying the ARC may or may not be paying down the unfunded liability. And so if we look at those total contributions, we need to understand there's other actuarial assumptions being estimated in the valuation. And those may be pluses or minuses each year. And so we need to understand there's an interplay. It's not just paying the ARC and it's not just investment returns. There's a 3.5% payroll growth assumption. So if there are no cost of living raises given or market adjustments in terms of the sheriff's office, if there's vacancies that are held open during the year and you're simply just paying the ARC, the annually required contribution percentage against the gross payroll, but your payroll is less than what was budgeted, then you're not paying that full amount. And so when you look at, we're only changing $300,000 or $400,000 in terms of that unfunded liability. If you have vacancies that you're not paying those contributions on, you're actually decreasing that. So you're still adding to the unfunded liability going forward. So understanding payroll growth, vacancies, and how those are affected with the annual required contribution and the unfunded liability, that present value calculation, you can see there's a lot of things that can work against you pretty quickly if we're not watching how the numbers change year to year. Slide 31, again, this pension formula, and this I'd like to summarize a little bit here is when you start to understand where the money can come from and how to leverage those investments going forward and what the limitations are, and the fact that the unfunded liability is a present value calculation that's going to grow into the future. Investment returns will not solve large unfunded liabilities. It's just the math is just not there. It really is about the contributions and how we do that. And additional contributions can leverage those investment opportunities because we're trying to squeeze as much as we can based on the risk we're willing to take. And how do we balance that? And then some math to go along with that statement. I had our actuaries calculate over a 17-year amortization cycle, an additional $1 million in contributions will save taxpayers an estimated $1.8 million in contributions over the next 17 years. And at the end of that 17 years, with the 1.8 million savings and contributions, that original $1 million would still be in the fund. It's still earning investment returns for decades to come. So kind of creating that large asset pool to take advantage can really pay off and save money over the long term. So with that, I guess that's the end of what I have prepared. If we want to stop and see if we have any questions.
Mike, thank you. That was great. I did have one question from our chat box, and then I have several questions, of course. Somebody asked about the DROP program, if you could explain that briefly.
Yeah, the DROP program, for the legacy tiers, that's not part of tier 3. The DROP program was designed as what they called it deferred retirement. And so it was an opportunity for someone who has reached normal retirement qualifications can qualify for their pension. And it was a way to incentivize public safety officers to continue working beyond reaching normal retirement. The way it works is if I use that 25-year example for a pension, and it calculated out as a $50,000 pension, I could get that $50,000. That goes into like a defined contribution. That $50,000 goes into an investment account for me. And I continue earning my regular salary, but my pension is set. And that pension is set aside. I don't get both incomes, I get one. Now that one, and you can do the drop for 5 years. And that pension payment goes in for up to 5 years, however long that is. You have to stop work. But whatever money is accumulated in that drop fund becomes a deferred compensation balance that's available to the employee. And then they continue receiving their pension into the future after they end the drop. That's a real quick explanation. I hope I nailed that for somebody.
Okay. If you reach your retirement age, and opposed to accepting your retirement, you keep working, and your retirement that you would normally receive goes into a 457 plan, would that employee then still make, would the employee and employer still make PSPRS contributions while they're in the drop program?
No.
Okay.
No. They're not required to, and that's actually one of the things that we have done in the past about an opportunity to have additional contributions, is an employer could continue making contributions because it's budgeted it's usually budgeted that way against payroll, but it's not required.
Okay, interesting. I do have a couple questions since I have you here. we often hear at the local level, overtime is maligned and said that it can contribute to a high 3. I'm just wondering, have you seen any local policies limit overtime, and has that had a positive or negative effect on unfunded liabilities, or is there even any merit to that argument?
Yeah, just if you just follow the math, it does. If anything, so when you refer to the high 3, so the calculation is out of your last 10 years of employment, they take the highest 36 consecutive months. That's your average pay for calculation of your benefit. Obviously, it's usually the last 3 years with pay increases, and then adding overtime on top of that. If you've been getting a certain level of overtime throughout your career, that's been your income level that the estimates are based on what the benefit's going to be. Taking a different track and having that grow at a much higher percentage by adding more overtime is going to get a higher calculation of that final benefit. I mean, you could look at it a couple different ways. It will increase the total overall liabilities. However, that total gross pay goes against the contribution percentage, so you would have increased contributions at the same time. So, and I know it gets to be a political discussion. Who do you want out there? Do you even have options in terms of overtime if you have vacancies for officers? Yeah, there's a lot of moving pieces to that puzzle.
Absolutely. I think the same conversation that we all hear that's been seminal in Pima County is obviously the Stone Garden. So I think it would be valuable if that overtime was consistent throughout the career, so the payments would be paid based on their overtime as well. But I guess that's one of those wait and see kind of things, and hope we make the best decisions locally. Speaking of local decisions, I chatted with Christian about this. Is there any thoughts or movements on the local boards? I know some local boards may have been criticized for not making the best decisions. So is there a movement to take away some of that local control?
So there was legislation proposed this past year, with the legislature stopping their meetings due to the COVID pandemic. That kind of just fell by the wayside, and it did not move forward. I anticipate that it will be coming back. There's some opportunities there. There's some things in the past where local boards and decision making, training, it puts a lot more definition around training that PSPRS will be providing, oversight requiring minutes, reviews, audit capabilities of decisions. There's and the title of it was a local board consolidation. And I know I had challenges with this at Coconino County. We get local board members, but we would only need meetings a couple times a year. And so really getting the expertise and having the depth of understanding was difficult. And especially when you start considering disability decisions. So the consolidation is an opportunity for plans to come together and consolidate under a single board to really have more resources available if you need to hire outside counsel to give legal advice on some of those decisions. Because if you're a small jurisdiction, may not have a lot of funding, and you only do this a few times a year, maybe even once every few years, it can really put a strain on the local government, and it's really challenging to come up with good decisions. So it's kind of a way to try to look at the resources available, get some clarity around how those decisions are made and who's responsible for what decisions.
Thank you. Good information. I can only speak for myself, but I would greatly support some type of consolidation of the boards. I do have a question in my chat box here. They ask, have low interest rates led PSPRS to seek riskier investments?
No. We're continually looking at that risk-adjusted return. So and valuing what's the level of risk we're willing to take versus the return that we get. And the low interest rate, it will change the way we value things going into the future in that analysis. But we're looking for long-term investment returns. Christian talked about a lot of those different types of investments we're in. One of the longer range, the private equity side, we look at investment cycles that can be up to 8 or 10 years long. And so what happens with interest rates year to year, month to month, is really not going to impact that type of an investment cycle when we have something long term. And so, it will play into what our future returns are looking like with the low interest rates, and it'll be part of that overall strategy. But it doesn't impact how we look at individual investments, so to speak.
Okay, thank you.
So I think it's kind of worth noting that with low interest rates, I think the immediate investment that somebody would think about would be bonds, because we have a very small degree of our portfolio. I believe it's probably less than 5%, if not maybe 2 or 3, is invested in bonds. With bonds and long-term interest rates being so low right now, there isn't a great deal of investment into bonds, and in turn, your worldwide markets direct their momentum and interest towards stocks. So I think where you see the low interest rates in bonds, you have to look at, of course, those forces are pushing other sectors, your stock market, your private equity. They're driving the value and the interest in those investments upwards. So it does play an effect that, of course, it's a little bit more difficult to earn money now with interest rates at less than 1% than it was, of course, 20, 25 years ago when you could park money in bonds and watch them grow by 6 to 8%. So it is not having a real impact on individual investment decisions, but those are forces that we see pushing up the value of other investments.
Okay, thank you, and thank you for the question. Another one, I was wondering if you could touch on what the City of Flagstaff did. I know it's a deep topic, and we don't have so much time, but they, from my understanding, they took out some loans with a COP process to pay off their unfunded liability. Could you give us a quick primer on that?
Yeah, so the basic way that works is because we have a payroll growth assumption of 3.5%, the target that the actuaries work on is to keep the contribution rate consistent year to year. And so what happens is with the growth on the liability side, because it's a present value calculation as you go forward, that's going to continue to grow. The contribution dollars increase over time. It's just, that is the way the math works, right? And with the low interest rates and borrowing opportunities, they're looking at an interest rate somewhere below 4%, so somewhere in the 3s. When you compare that to the liabilities growing into the future at 7.3%, and those contributions continuing to increase each year, the contribution dollars, a level debt service payment. So City of Flagstaff basically issued 20-year COPs with a level debt service. And what that does is, so a year from now, their contributions are going to decrease because the unfunded liability is going to go away. So that unfunded portion goes away out of their contributions. The reduced contributions they're using to make the debt service payment on that 20-year COP that is actually a break even in the first year, and then starts to grow savings. And the present value of their savings, I believe, is about $45 million in present value savings when you compare the debt service to the reduced contributions into the future.
Okay, thank you. Last question I have, I apologize, I had a list of questions, of course I would. I think we've seen the City of Prescott have a dedicated revenue stream as a tax for PSPRS. Do you see this happening more often in local municipalities, or is there the political will at the state level for a state level dedicated revenue stream, a tax for this?
Yeah, I've heard talk. There have been questions about a statewide tax to help pay these down. That is more of a political discussion. The fact that the public safety system is 264 different plans that are all at a different level of funding. I think the natural discussion, I think, is going to gravitate towards, well, if we're a well-funded city, why are we paying this tax towards other cities that are not? Mm-hmm. So I see, in terms of public safety, more local decisions. I think, and that's one of the reasons that I'm trying to get out more and have these conversations, is to get to an understanding about, is there an opportunity? Because if this will save taxpayers money, into the future, even if it's an additional tax, but if it's a tax over a couple years, it gets to full funding that then saves money for taxpayers. I think having that information and letting each jurisdiction make their own decisions is a good choice. So, Flagstaff went down their path, Prescott did theirs. Coconino County, we had a little bit different idea. We had a different way of coming up with funding. We had money set aside in a capital facility fund. And so we used that cash to pay down the unfunded liability. And then when it comes time for the facility, we'll look at a debt financing to pay for the new facility. So it's a little bit different than what Flagstaff did, but looking in total, what's the cash we have available and what's the financing we have available to get everything done?
Okay. All right. We have one more question, and this is somebody from our office that is a financier. So I'm going to read their question. They know what they're talking about here. So last one for him. For the 20-year COPs in Flagstaff or Coconino, did the COPs lose tax-exempt municipal status?
Yes, they were not tax-exempt. They were taxable COP.
Okay, Mr. Collin, there you go. No more for you. Well, gentlemen, that's all my questions, and we had some from the chat box. I can't thank you enough for joining us, and I think we're doing a good thing here, reaching out and talking to people locally. So I just want to say thank you to Christian there in Phoenix and Mike for dialing in from Flagstaff and dealing with the technical difficulties. We've spent more time over the last week playing and organizing this than the actual webinar. So I want to thank you for that.
Yeah, well, and thank you for all your help with this. And we appreciate having the opportunity to talk to all of you.
Excellent.
Dan, thank you so much.
Thank you. I'll get this PowerPoint on our website, and we will post the live recording on the website as well. So it'll be up there for a while for people to listen to. I know it's a topic of interest and conversation down here. So after this, I'm gonna do my little lecture on property tax. So you gentlemen are welcome to stay on and listen. We're combining this with some educational stuff as well. So that's all I have, and I want to thank you. And we'll switch over to my talk now, and we'll talk to you soon.
Thank you very much.
All right, thank you, gentlemen. All right, good morning, everybody. That was very informative. That was great. I'm glad we got them down here to do some talking. And I think it's good for all of us to really understand what PSPR is, how it works, and we've got ourselves in a little predicament and maybe some options about what we can do. So now's the last of our lectures on the academic side. There will be one more webinar in 2 weeks, and that will be July 10th, I believe, right before the county adopts the adopted budget for FY21. And that one will be more about the county budget itself. But as far as budget talks and the academic stuff, that's where we're at here. So property tax, this is a big one. Last week we talked a little bit about tax in general, revenue streams, the advantages of certain types of taxes themselves, but property tax is always a big topic. So let's just get into this one. I've got my PowerPoint here, and let me get my notes, grab a sip of coffee, and let's get into this. All right. We'll talk property tax, how it's calculated, the three things that are in the calculation, and special districts as well. Okay, this is a little political humor, if I may. Looking at the sides of the aisle, you may hear one side say taxation is theft, and you may hear the other side of the aisle say property is theft. Well, I think the only thing we could get people to agree on is that property tax is bad. A little humor there for esoteric tax people. All right, really, what is a property tax? There's three parts. Your assessed value times the rate, and that equals the levy. So the assessed value is the value of your property times the tax rate, and that equals the levy, the amount of money that's generated. In the last few lectures, we've talked about levy. I think of it as a verb. What tax or charge is levied on the population to provide the service? So the levy is really that word we want to concentrate on. But there's a little bit more to it than that. I always say it's a team effort here. So when we think about property tax, it's one of the most constitutional taxes in the state of Arizona, because it's controlled and collected and determined by our constitutional officers, the elected officials. So it starts with the assessor assessing the property. Then the Board of Supervisors adopts a rate, and then the county treasurer collects the levy. So there's three constitutional offices there, all elected, that have their hand in three different parts of this levy in the tax. Okay, but there's more to it than that. See if I can bring up a calculator here to run through this. So let's just say we do this. We always use the example of a $100,000 home, right? $100,000 home times our rate. But remember, our rate is per $100 of value. So when you say the county rate is $2.6747, that is per $100 of value. So we take our $100,000 home, divide by $100, right? And then we times by the rate, 2.6747. And that levy is $2,600. That's what you pay on a $100,000 home. I'm sorry, that's what we get, but that calculation is not correct, because nobody pays that much for a $100,000 home. The point we're missing is there's an extra part called the assessment ratio, and that's the way the state legislature controls the rate of taxation based on property type. So what you're going to see is a home is assessed at 10%. So to get this, you have to start with your home, $100,000, times it by 10%, then divide by 100, then times by 2 close enough your rate, and that's how you get a county tax payment on a $100,000 home of $264. So let's keep going into this. Okay, we're still live here. All right, so let's think. There's a few more terms and concepts we'll talk about before we get to that legal class and assessment ratio there in the middle bullet. So centrally assessed and locally assessed. As I've been saying, let's not forget we are an arm of the state. So whatever office you think about, remember there's the state that sets the rules, and there's 15 counties that execute those. So there's 15 county assessors, 15 county sheriffs, 15 health officers, 15 recorders, 15 treasurers. So how this plays out on the assessment side is locally assessed properties are assessed by our 15 assessors in the 15 counties. Locally assessed are things like homes and businesses, but what's centrally assessed? It's the big things, mines, mills, pipelines, maybe things that cross county borders, major things that need to be assessed equally across the state, because you can't have major industries moving between counties for different assessment rates. So that's the difference between your centrally assessed and your locally assessed. When you think centrally assessed, just think they do it up in Phoenix, and it's the big things, mines, mills, power plants, stuff like that. All right, it's going to get deep here. What about our full cash value versus limited property value? So when we look at that assessed value, it's not always the same. The full cash value is cash money, what your home is worth on the market. When you list it or when you sell it, that's what you're looking at, the cash value. But to limit the growth in full cash value, say to a housing bubble, which may inflate home prices and then inflate assessments and potentially inflate property taxes, what we have in Arizona is a limit on that. It's called the limited property value. And that is from Proposition 117 in 2015 is our assessments are limited to this limited property value, which means it can only increase 10% year over year. And it's the 25% difference between the full cash value and the limited property value. And let me rephrase that. In 2015, Proposition 117 changed that to 5% growth. So even if the market booms, we can't increase your assessed value more than 5%. So with that, let's get into legal class. Okay, legal class, let me pull this up. I want to show you guys this. So how do they come up with legal classes? Every property has a different legal class. So am I still sharing here even though I've changed screens? Okay, let me share again here. Okay, let me try that. There we go. So you haven't missed anything major in the PowerPoint, but I should be sharing the legal class. Okay. A property class is determined in the state legislature in the Arizona Revised Statute, and there's many different kinds. You can see property class 1A or 1, 1, 1, 2, 3, and it goes all the way up to, I believe, 9. The point we're looking at is the description. The description and the assessment ratio. So a mine or timber, or gas or electric, airport, oil and gas, water utilities, pipelines, those are assessed at that 0.18 ratio. So you would take your limited property value, times it by 0.18, and then times it by your rate. Shopping centers, golf courses. Then we get to, so we get into 3, and then with 3 we have primary residence, and that's where we get that 0.1 rate. 4, secondary residence, still 0.1. And this is where we've seen there's been a little bit of tussle over what we call the Airbnbs or the vacation rentals. Some people think that they're commercial and they should be assessed or charged a different assessment ratio so they pay higher property taxes. What else we got? Railroads are 0.14, foreign trade zones 0.05, healthy forests 0.05, biodiesel fuel manufacturing 0.15, and then what's the lowest here? 0.01. Residential commercial historic renovation. So know that there's these 9 categories, but dozens of different legal classes that all have different assessment ratios. And those assessment ratios plug into this equation right here, timesing your limited property value. Okay, is the screen sharing working here, team? Let's see. Okay, I was a few minutes ago. I think we're good now. I've got the red line. Okay, so that's your legal class and assessment ratio and how it goes into your property tax equation. All right, what about the PILT? This is your property in lieu of taxes. So the federal government, in their ultimate benevolence, they don't pay property tax. We don't send Coronado National Forest a property tax bill, or we don't send the Bureau of Land Management a property tax bill for the San Pedro River. So what happens is they understand this, and every year they approve in Congress, hopefully, what's called a payment in lieu of taxes. So they say, listen, we're not going to pay your property taxes, but we're just going to give you a chunk of money. So what that comes out to, in Cochise County, we usually get $2.3 million. So for all that percentage of our county that's National Forest, Bureau of Land Management, things like that, they give us $2 million and say, we're not paying your property taxes, here's some money. So that's what we'll call the PILT, the property payment in lieu of taxes. All right, 2 other concepts we're going to talk about, and it's going to get deep: the truth in taxation and your new construction. So the truth in taxation is really is how we determine a tax increase. This is a graph I put together. So you see the levy, the green, is the same. To keep the levy the same, the taxes you accumulate the same, your assessed value and rate do this inverse dance if the governing board chooses to do that. So starting out on the left, my assessed values go up. Well, to keep the levy the same, my rate has to go down. Now, if my assessed values start to go down, I've got to raise the rate to keep the levy the same. Then if they climb back up, I got to lower the rate to keep the levy the same. This is what it looks like if you keep the levy the same. And this can get political, where you need to understand what we're talking about and what part of that equation. The Property Tax Oversight Commission and the Arizona Tax Research Association are only concerned with the levy, the actual money that we raise. So what you see is the assessed value can go up and down, the rate can go up and down, but we're only concerned if the money that is levied on the people increases. So if somebody says, well, I didn't increase the rate. Well, if you didn't increase the rate, but the value went up, the levy went up, so you raised taxes. Or if the value went down and you don't raise the rate, the levy goes down. And if your values go down and you raise the rate, you could be accused of raising taxes. But in reality, the levy's the same. So it's very nuanced, and you need to understand what it means if you're going to talk about it in a political venue. So let's keep going here. We talk about the different rates. Okay, I want to do a little bit more on the truth in taxation. Apologies. Okay, screen share's working. People are still logged on. Thanks for bearing with me here. The truth in taxation. So when we get to this, how is it calculated, and how do we talk about new construction? So this is going to get complicated. So when I look at this and how I determine if we need to do a truth in taxation hearing is this. I look at my net assessed value, my rate, and my levy. So what we only need to concern ourselves about is if the levy increases on the current volume of property. So if I build a new subdivision, that will increase the net assessed value and increase the levy, but that isn't a tax increase. It's just more people with homes paying taxes. That's not a tax increase. So how do we do this? right here. We look at the FY21 net assessed value, and these are the actual numbers for the county for this year. 973 million. Last year's was 941 million. The increase in our net assessed value is 31.5 million. Okay, is that due to an increase in property values or the increase in amount of properties? Are more people paying taxes or are people paying higher taxes? So let's go down. So we look at the volume of taxes and we can break this down right here where we say, okay, our new construction was 12.1 million, but the increase in value of last year's volume of homes was 19.4 million, and our total increase is 31.5 million. So you can see of that increase in net assessed values, 12 million is from new construction, new homes, new people paying new taxes, and 19 million is of our current homeowners' value going up. So what we need to do we need to lower the rate because the volume, because the prices went up. So we back calculate this and say, for us to decrease that, to take that 19.4 million out of the equation, we lower the rate to 2.6206. So that means that this levy of 25.5 million would be a flat tax, not a tax increase. That we reduce the rate so that, just like the chart, the values went up, so we reduce the rate to keep the levy the same. So when do you have to do a truth in taxation? The truth in taxation comes when your levy increases because of the increase in taxes paid by the current volume of people. So what we have here is our new assessed value. We kept our rate the same this year. That's what the board decided. So our levy generated is $26 million. So what we're saying is the taxes paid, the levy did go up because your property value went up. So we go down and we say, okay, that increased in assessed value from your increase in levy from property values going up, the county will generate another $519,000. That's not including the new construction. The new construction generated $325,000 for a total of $845,000 in levy. So remember up here, this is the assessed values increased, and this is the revenue, the levy that it increased. So what does that do? That is a 2.06% increase in levy. And what we always do in our truth in taxation advertisements is propose this on a $100,000 home. So remember when we did the calculation on the calculator and we said your $100,000 home, you're going to pay $267. But if we lowered the rate to keep everything the same, that would be $262. So what we're saying is truth in taxation, our levy increased by 2.06%, and on a $100,000 home, your taxes will be $267. And if we didn't, or if we did lower the rate, your taxes would be $262. And that leads us to a $5 increase on a $100,000 home. So that's what the truth in taxation is and why we do it. I know it gets pretty deep there, but I wanted to go through the calculations. All right, back to the PowerPoint. Let's see where we're at here. Okay. All right, rates. So someone asked me, well, what's the county rate? And I go, well, I can give you the county rate, but not by an actual property. So there's a lot of different rates out there, and I want to get into this here. So the county taxing districts that the county controls are listed right there. The flood district and the library and the actual county. Another thing I'm going to touch on is primary and secondary here. So you can see the county rate is 2.6747, flood district is 0.2597, library is 0.1451. And the other major ones are Cochise College, which is 2.4516, and every city has a property tax as well, ranging from the lowest in Wilcox, 0.41, to the highest in Bisbee, 2.9152. So you're going to see on the left column, it says something about primary and secondary. So what is a difference between a primary and a secondary property tax? So that really is, it's defined in the statutes and it's kind of vague. It says primary property taxes are ad valorem taxes except for secondary property taxes. I just want you to think core government services. So when Cochise County levies a primary property tax, it's for our core services like the sheriff's office, the assessor, the treasurer, those type of things. When the cities levy a primary property tax, it's to pay for those core services that go into their general fund. Well, your secondary taxes are all over, or all others. So secondary would be a bond, or your library district, your flood district, fire district, school bonds, hospital districts, road improvements, water districts, and streetlight districts. So your secondaries are really all other for not core inherent services. So that's really the difference there. What about rates, the highest rates? So we look, these are the county and city ones you may hear about from the county board and your city councils. But who's the big dogs? That's your schools. These are your primary tax rates, the highest in the county. And they're all the school districts. They have different rules and different boards, and your city councils and board of supervisor can't control this. So you look, the highest is there out in Bowie, 10.8. That's 4 times the college rate or the county rate, you know. And then the rest of them are 8.9, 8.5, 8, 6, 6, 5, 5.1 for Ash Creek. So it's when we talk about school districts, they're not cheap. And I remember Victoria from Sierra Vista last week having a graphic, and I have one here that shows where property taxes go, and we'll get to that. Okay, what about taxing authorities? So last week, someone at the county said, "Hey, what's the tax rate in the county?" I go, "Well, I can't answer that question because it depends where you live." So I want everybody to think about where they live and what taxing districts they are in. It depends on where you live, how many different tax districts you're in that make up your property tax bill. It's not, and it varies so much that I think this is the most important thing you're going to hear today is it varies so much. It depends where you live. So the highest tax area code, or we call tax authority, is out in Bowie, the top one. 21.5617%, and that's because they're in the Bowie district, the North Country Hospital district, the Bowie Fire District, and the Bowie Streetlight Improvement District. Or let's go on the other one here at 19.05, Ash Creek, Valley Union High School, North Country Hospital, Alfreda Fire. So when you see these things start stacking up and you're in 3, 4, 5, 6 districts, it's not cheap. Now let's break out the calculator. We can do this, right? And sometimes I feel bad for these people out there. Okay, so let's say we're in Task District 1475, $100,000 home, right? Times our assessment ratio by 10%. Divide by 100, because our tax rate is per $100 value, times 21.5617. $100,000 home out in Bowie pays $2,156 in property taxes alone. So that's the difference. That's a lot. But when we get to special districts here, the last few slides, you'll see it all come together. So I'm not saying they're doing anything wrong. This is an example like that picture that Victoria showed. Okay, this is for Buena High School, Sierra Vista, property tax, primary and secondary. See, the schools is 49%, the county's 27%, the college is 22%, the cities is 1%, and the fire is 1%. And I know some of our more astute students out there go, Dan, I got you on this one. Sierra Vista residents are protected by Sierra Vista Fire Department, and that's a Sierra Vista city function, so they don't pay a fire district tax, so you're wrong. Oh, you guys almost got me, There's this extra little tax called the Fire District Assistance Tax that is levied on every single property in the county at 0.1% for fire district assistance. So no matter if you live in Sierra Vista and have got the awesome coverage of Sierra Vista Police Sierra Vista Fire, you're paying an additional Fire District Assistance property tax. And where does that go? It goes to the county treasurer and then is dispersed to fire districts based on a statutory formula. So what it means is every property, no matter where you're at, pays a little bit to a fire district, even if you're in a city and have city fire coverage, or if you're not even in a fire district itself. I know some people don't like that, but that's what the statute says, so we have to do it. That's interesting. All right, some other notes about our property taxes here. When I look at this Sierra Vista example, so the primary is 10.08, secondary is 1.09. So your total taxes in Sierra Vista, for this example, based on the location in Sierra Vista, you're looking at 11.12%. That's not bad compared to out in Bowie. All right, so but what does that encompass? That includes 11 individual taxing districts. So this pie reflects 11 different districts. My home in Sierra Vista is overlapped by 11 different districts hitting me for something. So what are they? Well, there's 4 county. That's what the Board of Supervisors is responsible for. Only 4 of those 11. That's the county, the library, the flood district, and that fire district assistance tax, which is mandated. The rest, the other 7 districts, have individual governing boards. That's the City of Sierra Vista City Council, Cochise College, the school equalization tax, your elementary tax, your high school tax, your school bonds, because the elementary and high schools have bonds they're paying off, and the joint technical education district. So what we see is it depends on where you live to see what your tax rate is. So on this, when we look at the county-wide, depending on where you're at, here we see the max is your primary property tax can range from 7.5 up to 16.4. Your secondary property tax can range from 0.5 to 7.9. And your total tax rate, depending on where you live, could be 7.9 up to 21.5. So when you're going to buy that house, the best thing you can do is go ask your realtor, what's my tax area code and what are my total primary and secondary property taxes? Because you don't want to think your property tax is going to be 10% and it turns out it's 21. That could add hundreds of dollars to your mortgage. So I want you guys to think about that when you're making those personal decisions, but I hope it brings some understanding to when somebody asks me, yeah, what's the property tax? I go, well, how much time do you have? All right, where are we at here? All right, the last thing I got, special districts. And this is my quote of the day here. Special districts are the cornerstone of democracy. Depending where you live, you may not be in a city and you don't have to be. Special districts are little pieces of cities. And there's many, many options. So let's say, we're a democracy. So a group of people live in an area and they want to start a city. Okay, when you start that city, you have statutory obligations, statutory services you have to provide, and you have the statutory authority to tax property and sales tax. That's if you incorporate as a city. If residents don't want to do that, they can choose their own adventure with special districts. So what a special district is, it's a little piece of a city. So if people come together, they don't want to incorporate, they go, well, I don't want to incorporate. All we need as a group of people is fire protection and a hospital. So they'll start a special district for a fire district and a special district for a hospital. And those, the only statutory options for your special districts, though, for the most part, are property taxes. So when I talked about Bowie having high property taxes, it's because they're not incorporated and they may not have the authority to charge sales tax. So because they have zero sales tax, they have higher property tax. So it's not that they've made bad taxation decisions. It's just the only mechanism that they have. So really, it's about people coming together and deciding what structures of governance they want. And I think it's a beautiful thing because not everybody wants to be in a city. Not everywhere needs to be in a city. They can just choose what they want, and it's great. So how many options for special districts do we have? Well, if you need some reading material, I would recommend the Arizona Revised Statute Title 48. There's over 30 types of districts, and I'm going to read them all because it's my webinar and I can. All right, anti-noxious weed districts, pest control, municipal improvement, fire districts, county improvement, county television improvement, community park maintenance, cotton pest control, special road, power districts, electrical districts, hospital districts, sanitary districts, pest abatement, health services district, agricultural improvement, drainage and flood, irrigation, flood control, multi-county water conservation, free library district, jail districts, stadium districts, groundwater replenishment, active management, regional public transportation, regional transportation, special health care, agricultural preservation, public health services, multi-jurisdictional water facilities, recreational corridor channelization, Upper San Pedro Water District, revitalization districts, and are you ready for this one? The theme park district. Yes, the Arizona Revised Statutes will allow people to come together, form a special taxing district, and start a theme park. So I try not to get political here, but voters of Cochise County theme park district, what do you think? Can we get it on the ballot? I would spearhead that one. So the point is, not everybody wants to be in a city. Not everybody has to be in a city. And you can pick and choose the parts of the city or the services you want that your community needs based on what the community needs and wants. So that's special district. All right, that's all I got. I think we went the full 90 minutes today, but of course, send me some questions and thank you for bearing with some of the technical issues. Let's pull it up, see if we got any questions. No questions, all right. Things must have gone great. All right, send me some questions. I'll hang around for a few minutes. Other than that, I appreciate your time and we're gonna get this one posted as well. This was the big one, you know, with PSPRS. It was great to hear from them. I liked what they said. I appreciate what they said, I just don't like what it means. So thanks guys, I'll be here for a few minutes and be watching the chat box. All right, no questions, but a good job. I'll publish that one. Any critiques get dismissed. All right, I'm not seeing any questions, so appreciate your time, and we'll call it a day. You guys have a good one.